Morning all, welcome to the market view for Thursday the 14th of August 2014, and starting off with the British pound 30 minute, you can see the dramatic effect that Carney's ramblings had on the market yesterday, but more on that in just a moment. You can see we had a buy signal at 7 a.m. yesterday morning, and as I advised yesterday, the best thing to do is to get out of the market before we had the economic news at 9:30, and then of course at 10:30 before Carney uttered his words of wisdom for the market. So at best, you're looking at break even on this trade. Then we had the potential sell, but of course we had Carney speaking, which is always an interesting one because, let's face it, he keeps coming up with excuses and reasons as to why he shouldn't increase interest rates. When he first took office a couple of years ago, it was forward guidance, whatever that is, and then he switched to avoid increasing interest rates from his forward guidance details to unemployment figures. If they dropped to 6%, sorry, it wasn't 6%, it was 7%, then he would have to consider raising rates. They're now down towards 6%, no rate increase. And then yesterday he comes out with a blinder about wage increases and wage forecasts, and because there's a gap between the growth of the economy and wage rises, he doesn't see any reason to increase interest rates, and he's now put this off until next year. Well, surprise, surprise. The real reason for interest rates being kept on hold, and they are going to do this for as long as they can, I'm telling you now, it all comes down to the fact that we are printing 200 million per day in the UK to pay the interest on the UK debt. And any increase in interest rates is going to have a knock-on effect on the printing, or rather the amount of interest that is going to accrue. So there's no surprise whatsoever. You're going to see this continue. There's going to be excuse after excuse to not increase interest rates. And it's got absolutely nothing to do with the economy. When interest rates go up, it will be something to do with the bond markets globally, not to do with the economy. The economy is stuffed. It will not improve. It hasn't improved in 5 years, even with the printing of money, and it won't because the interest on the debt is continuing to grow. But of course, they won't tell you this at the biased broadcasting company or any of the other media outlets because they don't want you to know this. But that is the case. That's the real story behind the news. So don't expect any increase in interest rates in the foreseeable future. Don't even expect in next year, because no doubts Carney will find some other part of the economy that he can cite as a reason not to increase interest rates. So that's my rant about this. It's probably more accurate than the BBC's because it's based upon facts, whereas you can do whatever you want with wage forecasts because they don't exist. But what does exist is the 200 million per day that we're actually having to print to pay for the interest on the debt, which equates to 1 billion per week or 52 billion per year, which is generally printed around November when the interest or the payment on the interest on the debt is due. So this is why you saw the pound react this way yesterday. He started off on a positive note, then changed, then the excuses came out, and then we see the pound trading down all the way to 167, and this is where it's remained ever since. So again, no surprise really. It's just rhetoric from Carney without any facts. Like I say, this is the second year now that he's come up with some other scheme or shifted his focus with regards to what needs to happen in order for rates to rise. So you can expect more of that in the future. In the 60-minute chart, it was exactly the same. The sell signal beforehand, but of course then you see this sort of 100-point drop, the biggest drop we've had in the pound for some time. But like I say, it's backed with more specious arguments by Carney. In the daily chart, you can see the market trading down to the 167 level, which is where the previous move to the upside took place, through the 76% retracements now, so we can just remove all of these. And we're now trading at the recent lows. So let me just grab a zero, draw this across, and this is where the market is likely to find a bit of support in the short term. So the pound sharply lower yesterday due to Carney's ramblings and trying to wrong foot the markets, and also most of the financial press as well, with his new take on why he's not going to increase interest rates in the short term, and again postponing this until 2015. In the Dow, let's just have a quick look at this. So yesterday we see the Dow moving higher once more. We're moving higher on low volume as well at the moment. So we need to just put in some sort of 76% retracement. If I look to the previous left, I can see that this is the next high, and I'm just going to draw down to there and draw across, and you can see that yesterday we hit the 76% retracement there. I'm just going to remove some of these other lines now just to make the chart clearer. And speaking of the Dow, I've started recording a market view for the Dow as well, which will be available from tomorrow. I'll send you the links tomorrow so you can actually have a look and see what's coming towards the probably mid-September. So the Dow trading strategy, that is to go, it'll be combined with the pound. Once the pound cheers up a bit and starts to give us a bit more volatility, combined with the two, should offer far more pips. So far so good, so you'll get an idea of what things are going to look like from the market view, but the settings and the software won't be available for a few weeks yet, but it just, at least it shows you what is coming as far as adding to the sort of lackluster performance at the moment of the British pound, but to, of course, offer more potential trades. And so far, as I say, it's been really good, with a lot more pips being made available, somewhere in the region of around 400 per month so far. So the Dow moving higher, just going back to this, 76%, 16,741 is sort of a resistance area for this. And then the implied, which is very interesting, has fallen out of bed at 10.75, 12.06 yesterday. And again, this reflected in the price chart, which is very odd. It's quite a big drop of 1.3%, that sort of area for yesterday, if not more actually. So again, an interesting picture there. Why this is happening, I don't know, considering that the market is it's moved back, but it hasn't moved back that much. So again, an interesting picture that we're seeing as far as the implied volatility is concerned, unless it's some sort of summer madness that we're experiencing at the moment, but very strange indeed. Right, well, that's it for today. As ever, thank you for your support. It's very much appreciated. I will see you in tomorrow's edition, and as ever, thanks for watching.